Hi guys, this is Viper with $1 stock picks. I'm going to go over trade ideas today, and I'm going to go over how to create a scan, um, what to put in it, back testing, risk reward, account management, um, and basically just how to look at this thing, because there's several angles that you can look at trade ideas as you're going into building a scan. And my idea into it is the fewer the trades with high profitability is key. Because, for instance, I had gotten a scan off of somebody that it was a 5-day momentum scanner, and they use it all the time, and yeah, they make money off of it. But when you backtest the strategy, it's putting out 1,400 signals per month or more, and each one of those, see, like this right here, this is a signal. Right here, each one of these are a signal. That's a signal, that's a signal, that's a signal. Each one of these are a signal. And if it's putting off 1,000 of them and only 50% are winners, then you're only looking at 500 winners and 500 losers, you know? So with that, that's like still looking for a needle in a haystack. So we really want to bring those odds better into our favor, because that's the whole point of trading, is putting odds in your favor. It's just like, if you're at a poker table, you want the odds to be in your favor, or a blackjack or something like that. You want to try to have the odds in your favor. Now, when the odds aren't in your favor, what happens? You lose. When the odds are in your favor, what happens? You probability of winning is higher. Not exactly saying you will win. You'll probably lose more than you win. And actually, to be honest, it's the same way with the stock market. I can actually create a scan that is in negative territory faster than I can create a scan in positive territory if I was a long. Now, if I was a short, I could build scans all day long, and as long as you can short a stock, hey, there's plenty of opportunity out there, because to be honest, the market really goes down more than it goes up. It fights to go up, and it flows to go down. And if you actually look at a lot of charts, you'll see that where it's easier to flow and faster to flow down than it is to flow up. Look at the flow up has to consolidate, 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 and then we get a slow move up. We only got 25% move back from here to here, versus if you were to look at the consolidation before it went down, it was very short and then it was violent down. Same thing here, it was still violent down. This is a big gap down, so it's still violent down to me. This point right here where it started to come back down, come down quicker than it went up, so, and then it continued to go down more than it went up. So this stock from here to here was more down. And if you look at this over here, look how long it took to go from here to here. It took over 30 days to get from there to there. Actually, I think over 60 days. And then if we actually go back, going down was actually shorter, maybe like 15 days, and you'll find that in a lot of stocks. I can actually find that if I was to say Voxel, that's what I was actually on. Look at the down move. The down move is more consistent than the up move. The up move has a lot more resistance. So as a long, that makes your job harder. And I'm a long, so that makes my job harder. But doesn't mean it's not fun. So let's get into this a little bit deeper. I have some scans over here, and this is kind of what built into these scans right here off to the side. So I'm going to kind of go into both. Now we have this right here. This is kind of an interesting one. This is, and I've already labeled this one versus the other. The other, they're still holding their old names. But this one, it's a penny stock, and it only looks for stocks between 1 penny and $1. Now, does it mean that it won't catch stocks that go out of that range? Yes, it will. But what your goal of this one is, and as it says, it's a penny hold, 30-day hold, so you're going to hold each signal for 30 days. You're only going to invest $100 to $200 per trade. That's not 100 shares or 200 shares. That's $100. So, for instance, say you know, the stock is 50 cents. You're going to put in $200 for 100 shares. Okay, so you'll have 100 shares, but you'll have $200 invested. Okay, so I'm going to run a back test on this one real fast, just to kind of show you what the results are. Okay, so the results show that you've got a 6.89 profit factor. You've got 132 total trades within a 63-day period. All those were almost 78% winners, or 70% winners, which is good. Anything over 65% is pretty good. 68 is optimal. Higher than that is fantastic. Okay. Average winner loser, 27 cents to negative 9 cents. Strategy return, 962%. Oh, and I am invested way too deep. Okay, so we're going to go $200. Okay, now this is a balanced scan. Okay, now our buying power is 27. Our starting equity is 25. So technically, you need roughly about a $30,000 account to run this strategy. And put that 200. Okay, so roughly you need about $25,000 to run this. It was 30, but now it's 25 at 200. But your biggest winning day is 3,381, and your biggest losing day is $199. So if you go off risk reward, your reward is greater than your risk. Now, that is what you want in a scan. Now, this is the same scan, and this is called trading up with earnings. This is the same scan, except for I'm going to change a couple things on it, because the one thing that isn't on that scan that's on this scan is the actual earnings date. And volume's different because I look for different things when it comes to volume. If you actually look at most plays, your best plays are over 2 million in volume per day. I think that's right. Yep, $2 million per day. Okay, so now with that, let's backtest this strategy. It's the same one, 8 to 3:30, time to exit, 30 days out. And it's a mix. Coming out the gate, it looks like it's got some winning potential. And it does. It's 71% winner, so that's still good. But let's see. Our buying requirements change drastically. So for the same thing, we're getting 542 signals, and we're having to have an account of $120,000. That makes it harder for most people because they don't have $120,000. If you got $120,000, you're buying a house, not in the stock market half the time. So how do we get that into our range? We have to break it down. Now still, we got good winning days, good losing days. So our winners and losers are still, you know, in the right category. But we're still over trading at this rate. And even if I go down to $100 per trade, now that puts us in a strategy return that is negative, almost 27%. So if you started off at 24 with commissions, you're down at 23. Without commissions, using like Robinhood, you could possibly be at 28. and that's just by a simple change in numbers. And if I go back to my calendar is not showing me things. These calendars are actually helpful because you can actually point out what's going on. Your daily curve. Let me point out something here. Okay, so we're doing a 30-day hold. And if you'll notice by this graph, these first days are higher than these last days. And that's because we're doing a 30-day hold. Now, if I was to do a 60-day hold, you'd actually have no trades because it's doing a 30-day hold. So it's taking the first 30 days, and these right here are what are still being held and are actually gaining profit. Or actually, these are the ones that you're about to release for profit, and these are the ones that are building to become profit over the next 30 days out past that. So if you're looking at 63 days total trading, then the first half is your buy and hold and release. And these are your buy and hold and waiting for here to release. So this graph right here should end up looking like this by the next set of 30 days. So if I was to do another back test 30 days out from here or 60 days out from here, then these bars right here will look closer to these bars right here if the strategy is saying what it's supposed to do. So that's also why you're seeing a different return versus annual return. So even with, you may still find yourself in the same profit factor the other way. But I reduced mine down to where we cut down the trades, and I did that through the optimization. So basically you go, and I went through the other filters section, but if you start off, you can go with price, and as you can see, 70% win rate here, $80,000, and you can actually look at what the trades would have been. You can see which ones would be your biggest losers. So there's 154 biggest loser, and then 1400 as your biggest winner. Zoom those out a little bit to where you can actually see what symbols we got. We got TTMP, ADXS, AVGR, HLTH, CLDX, ADOM, HEB, JAGX, MNGA, and all of those are runners. They're all penny runners. So if you're familiar with penny runner stocks that run a lot, then you'll be familiar with those names. And that would have been a pretty good strategy, the 20 to 29 cent range, 70% win rate, 80,000 total capital. I don't think you'd actually get that much really because you're still only putting down so much. But that's a pretty good way to look at the scan. Some of my other ones though, now a way I like to look at this is, what are the signals actually putting off? So as you can see here, I've brought up the history on each of my scans here, and what it does is it just shows you basically what it's done over the time frame. So if I go to history, you have real time, last trading day, previous trading day, all, which would be all 63 days, or you can choose a time frame, anywhere between 0 days up to 63 days. And it'll pull up every signal that this scanner had picked up throughout that time. Now, I'm going to go through the bullish candlestick pattern one because let me show you. This little gem really blew me away. Now, I'm going to backtest this one first because this is the same one as this, but just this one is altered over here. Time to exit. I think that one's at the end of the day. Actually, let me look at its back test real fast because I want the back test to match each other. So 8 to 3, time to exit at market close 5 days later. So I decided to go 5 days out on that one. Okay. So now let's do the same thing. Back test 8 to 3, time to exit plus 5 days. We're going to go out 62 days and simulate buy. not looking good for it so far. Sitting pretty flat and negative if you've got commissions. Whenever you're seeing these pop up, this is without commissions. This would be your Robinhood line. This would be your Thinkorswim. So I use Thinkorswim, so this is the line that I focus on. And whenever I use my Robinhood account for smaller stuff, then this is the line that I focus on. So that would be my strategy return for each. In the same way, whenever it actually pulls up, it's full loaded. When it fully loads, and it actually brings up the graphics and everything. And give it a few more seconds. It's not too much further to be done. It's taking its time. 98%, so it's just bringing up a lot of signals. The longer that these things take to backtest, it's meaning it's going against a lot more signals, and it's having to look through more of the market for the criteria that is listed so far underneath it. So you've got all your alerts, and then you've got your filter criteria. So it's got to go through all of that throughout the whole market to find every stock that fit that criteria. So the longer that these scans take means the more signals that it's having to go through, which means that your odds are further down. Now, as you can see, this is a 62% winner, total loser on return. And if you actually look at your biggest win-loss, you'll see that it's almost split down the middle. And let's see. As you can see, we've got pretty hefty drawdown. If we look at the calendar and see some of the trades, you can see that, like for instance, this day there was basically maybe $30 to be made, you know, but there was over $100 to be lost. Same thing here. Even though this is a winning day, you're still looking at like what, $12, $10, $9. So not very good for you. And even if you put down more, let's see if we put down $1,000 per trade. It gets slightly better, but here's the issue: 3,126 signals in a 60-day period. 3,000. So let's divide that times 30. I think you're getting like 300 per day. Yeah, no, 100 per day. So you're getting 100 per day. So 100 signals per day, and you're supposed to put in 1,000 times 100, so you're looking at $10,000 every single day that you need to put into that strategy, and you got to hold it for 5 days. So that's $50,000 in a week that you have to trade, okay, to make this happen, and you're still barely above water. And you're still taking some hefty losses. So whenever I run this one over here, same strategy, almost same signals here are being put up, but these are different. And it's kind of amazing how just little details make a big difference. But in a minute, I'm going to go over how we actually look for pools of money. So I'm going to take just some random scan, and I'm literally going to do that. I'm going to probably close all these down and just take a random scan and we're just going to tweak it and see what we get, you know, just to kind of give you an idea how I go about the process of trying to find the right criteria to continuously be profitable and try to make it as easy as possible. Now, some of these scans are going to require different amounts of money for them to work, and that's something you got to consider with every single scan that you look at. So, and that's everything. Okay, so like I'm just looking at trade ideas, but just say I was in Thinkorswim and I was on their scanner, or if I was on TradingView and I'm looking at their scanner, or if I'm on Black Box Stocks and I'm looking at their scanner. I got to take this into consideration that I'm still looking at negative returns based off of, you know, how their strategy is set up. It may not fit my account. It may not fit my trading style. It may not fit all of that, and it may be a losing strategy for me. It may bring up losing trades for me and I don't even know why. And you ask yourself that question all the time. Why am I picking up this losing trade or that losing trade? Well, it's probably because your risk reward, your management of your money, and the way that the strategy is going about it is wrong for your account and your trading style. Now, as you can see here, we've got an 83% win rate. We've brought 3,126 trades down to 122. So we literally took off 3,000 trades, 3,000 total trades down to something we can manage. And as you can see, your biggest win day is still about the same, but look at the biggest losing day. Way different, way different, almost $3,000 difference. That to me is beautiful. The strategy return is slightly less, but my buying requirements are slightly lower. And say if I still wanted to only put $100 in, do that to both, $100 in. Okay, as you can see, even though this one's still a loser, it's less of a loser. My buying requirement is actually way less at 10,000 versus 50, and I can actually bring this up to where those match. So that's closer at 20,000. So then we become 2% return, 58% annual return, still 83% winners. That makes it to where over time, over 30 days, okay, so say over 60 days, I went from 24,000 to making a little over $400 with commissions, and making a little over $1,000 without commissions. So you actually do a little better without commissions, but you're still making money. There's a difference. You're consistently making money versus not consistently making money. Now let's change this up a little bit more, because as you can see, I've got a little bit more buying requirements. So let's bring this up to 300 per trade, because as you can tell, you can actually put in more on this strategy than this strategy. Because if I pull this over here and I look at my curve, even if I put in come on, my computer's slow right now. It's a tiny little laptop that I bought the other day from Walmart, which tells you a whole lot. It was bought at Walmart. Okay, let's put the same numbers. We want to keep everything consistent. Okay, so in this respect, in 64 days, I'd be down 5,000 with commissions, and without commissions, possibly up 2 to 3,000. But how would I even be able to trade that? Because look, I would need $127,000 to trade that. I wouldn't even be able to trade it. So this number wouldn't even happen. I would actually be break even maybe at best. And I would still be in losing territory with commissions no matter what, automatically. To me, that is way different from the last scan. And it was all just from changing a couple simple little things. If you look at it, I swear I'm outside underneath my carport, and I've been making this video. I've done it twice. I've had a loud truck go by. I've had my kids come out. I've had a helicopter just go over. It's like it's intentionally trying to say, don't make this video. And I'm trying to get this out to you guys because I really want y'all to kind of get a feel of why strategies fail, you know, and why you're not able to make money with these sometimes, you know. Let's get to a scan that everybody knows, okay? Everybody knows. And that is the high of day momentum scanner. This scan right here, everybody wants to try to have. And it's pretty simple, straightforward. Anybody can make this scan, and I've seen several people do it several different ways. But the heart of it, let me hide these, the heart of it is the new high filter. Okay, so if I was to take just the new high, not put in any data here, let me just take out all this data here, just take it all out. Anything here, don't want it there. And don't worry, none of these really make a big impact to this thing other than it just reduces how many signals are being put out. Okay, so with the high of day, you've got the new high filter, and what it does is anytime there's a new high within intraday, it will put off a signal. So say you're starting off right here and it pops above this creates a new high, it's going to send off the new high filter. And then as it's going up, it's going to continue, as it's coming up and making these new highs, it'll still show up on the scan. But the second it hits here and it starts to drop down here, you will no longer see it on the scan. It will be dead. It'll be dead to the scanner, and it's over. So you have to be fast with the high of day momentum scanner, because as it's going up, it's creating a signal and it's telling you buy, 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 and the signal dies and it's saying sell, 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 sell. You know, and that's kind of the way that you're supposed to use the high of day momentum scanner. It's made to be fast. It's not made for you to buy and hold. But it can be if you look at it the right way. So the way I would look at it is yes, it moved up here, but do I have more upside potential? So that's where technical analysis really comes in. You'd be like going, okay, so like give a mark up here, horizontal line. So say right here you see we have a lot of resistance in this area. So as it's moving up the new high of day and you're sitting there seeing it on this candle, not the second candle here, but this candle, you're sitting there thinking, okay, new. Let's keep that on radar because we have resistance up here. We have 200-day moving average up here. Will it make it up to that? And since it likes to top out in those areas over here, then maybe it will top out over here now that we're sitting here low and we're coming up above this resistance right here. As you can tell, we have several resistances that it broke through. It broke through right here, it broke through right there, and it come up to right here. And then as you can tell, the sequential days, it popped above that, filled this gap, and actually held inside of this gap with some little spikes coming out of it, showing that it really wants to come into a squeeze here. As we see, we're squeezing in between the 50 and the 200, and I like having the 50 and the 200 on the daily. And as you can see on my other chart, my 5-minute, I have nothing. You see that? Nothing. No VWAP. I should have volume there. That would be about the only thing I would leave there, but nothing. Why is that? Because moving averages show your resistance on your larger time frames. They don't really show it on your shorter time frames. It will occasionally show it on your shorter time frames. What I use on shorter time frames was a little trick that I showed in my room, which is the 20 EMA or 50 EMA on a 5-minute chart with the parabolic SAR. And I will do a video on that later on how I actually use that, but it's good for short-term resistance because parabolic SAR means switch and reverse. So basically it's a point where the market switches and reverses. And say the parabolic SAR is on this chart. Right here, it would break below. And it would actually put a point as it broke below down where this little candle point is. So if you're still doing technical resistance and you're good at that and you don't need the parabolic SAR, then you could have put a line here and a line here, and this would have been your zone. That would have been your stop zone. And as it come through with the parabolic SAR, it would have pointed here and then it would have rolled upwards. Now as things are moving in an upward fashion like this, as this is creating a little uptrend like right here, if I was to be back in an area of uptrend, so say this is an uptrend, you would get like a little hook and loop. And the little hook and loop, as it's going across and your 20 is coming this way, crossing basically through here, your little hook and loop pattern as it points out would actually say that this would become a buy signal. I mean, I don't have it on here, so like I said, that's just a way that I use the parabolic SAR along with the 50 and 20, and I will do a video on it, but right now we're just going to get back to what we're doing here. But like I said, you've got your support and resistance areas that you would be focused on. Now your high of day, let's back test it. Okay, so we're going to do 8:30 to 3, timed exit at the end of the day, risk management none. And I say risk management none because, okay, I'm doing my risk management differently. My risk management isn't based on stop losses. It's based on time. It's based on money put in per trade, and it's based on spreading that across multiple stocks. So when you're looking at these back tests, you got to think that it is trading like an algo. You're creating an algo here, you know, and if you put this into an algo strategy, it would automatically trade it. So every time one of these signals would come across, it would buy it or sell it, depending on how you have your strategy set up. So say I'm doing 8:30 to 3, timed exit 3, so it's buy time. It'll buy between 8:30 and 3 p.m. so it'll buy all day long. Even as the market's closing, it will buy even if there's a signal 30 seconds before the end of the bell. And then it's going to exit at 3. So say it bought at 3:59, it's going to, or 2:59, it's going to exit at 3. Or if it bought at 2:58, it's going to exit at 3. So it's trading like an algo. So it's going to give you your responses based the same way. So technically, you should trade as you set up your scan. Because if you don't trade like you set up your scan, then you're only getting signals. But your signals aren't going to give you, you know, winning trades per se, you know, because say, for instance, we chose this day, you know, and don't get me wrong, I know Billy. Philly's a popular one. PTE, that's a popular one. OMER, that's a popular one. LABD, that's a popular one. But as you can tell, they weren't real winners that day. Not that day. You know, whatever day this was, on 3/4/2019, they weren't profitable. You know, so that wouldn't have been good for you. On this day, which is your green day, we've got BPTH and YEXT as your winners. Everything else, losers. Well, you got one other winner, ALPS, and or APLS, and I actually don't know that one, but I do know RARX and the other ones that I mentioned, SPXS, BPTH, and YEXT. The other ones are kind of just standard stocks in the middle of nowhere. So with that, how are we going to make this scan better? Okay, so first off, let's get an idea of, maybe what we have. So say we have a small account of $5,000. Okay, and we only want to put in $100 per trade. That is our goal. Okay, and with that, you can see that we are in middle territory. We're losers on one side, winners on another side. So technically, if you have commissions, you're down within 30 days. If you don't have commissions, you're possibly slightly up, but you're still taking 222 trades, so you're still over trading. Okay, so let's go into optimization here. So with optimization, we're going to say, well, what's the best price point maybe to buy at? Well, maybe around the $20 to $21 range is a good one, because you're getting 60% win rate here with 23 trades, and you're getting a pretty decent profit factor, because I can tell your profit factor is 3.82 here. This one's not bad either. You're looking at 66% winners and 27 trades, so you're still knocking down your trades quite a bit. Okay, so that's just using price. Let's go to time. What time of day is the best time to buy? Well, that's an easy one to fix. We can actually do that one and run it again and just see the summary difference without having to do a whole lot of changing. So if we look, right now we're sitting at 222 trades. If we change the time of day, we're possibly going to get 59 trades. So if we're going to buy from 8 to 9 and still sell at 3. And let's see what we get. So we're going to, what was it, 8 to 9. And it won't give me the 8, so obviously I'm not buying at 8, but we'll buy at 8:30 and still stop buying at 9. And we're not going to sell at 9, but we're going to stop buying at 9. Our still exit time is still 3, so we're going to buy between 8:30 and 9, and after that we're not buying any more stocks. We're holding what we bought from here to here to here. Okay? And let's see what we get. Alright, so now we're at 60%, 64% winners. Let's go back over our summary here. Look at our numbers. Okay, so we brought our trades down from 222 to 59. Which at 59, and you're holding till the end of the day, you can actually put in more capital. Okay, and if you don't believe me there, just look here. Your buying requirements here are 2,600. So with that, if I wanted to balance this out, we can probably do 200 per trade. Alright, we're still under our buying requirements, so let's do 300. And we're about even. I'd say I would usually go slightly over, so I guess we can do 400 per trade on this particular scan. Alright, boom. Now we're closer to our buying requirement. This one, we can put up roughly about the same, if not more. And we can put in more, so put in And this is good though, you know, you got to look at it this way. That means that you can confidently put in more per trade, you can gain back more per trade and lose less per trade with better return. Just simple little changes. Simple, simple, simple. And I haven't even done anything but change the time of day. Everything about these scans are exactly the same. So, you know, I don't know why I went that high. Alright, so the difference between these two, if you have a $5,000 account, is you can put in twice the amount of money and win twice the amount of money and lose roughly about the same amount of money. So to me, that's a little better strategy, and that's just coming off of the 5-day momentum. And if I look at the calendar, you can still see I got some red days and I got some green days, but my green days outweigh my red days. If I go over through my equity curve here, or my daily, you can see that they're really not that much different, except for the fact that my red isn't quite as bad, but my longs are still about the same. So I'm cutting out the bad trades versus the good trades. And when you're going through optimization, so like for instance, these are your pools of money. You know, you've got, you know, 83% win rate, 80% win rate. But then you've got how much you make per trade. So you got 5 trades. Average trade is about $85 here, or rounded out between these, it's about $85. So if you took these and got a mean average, it would be about $85 that you would make per trade, even though you've got one trade in there that's $600. Now let's do other filters. Now if you come over here, you've got other filters and you've got columns, and it literally goes through most of the filters, not the alerts, but the filters. And as you can see, as we scroll through these, okay, volume percent yesterday, let's just give an idea. We got 78% winners, 19 trades, $205. That wouldn't be too bad. You would lower your, that would make it to where you could add a little bit more capital into your trade. See if we can find one that gives us a higher win rate of maybe like 70% or more. This one's actually not bad. I kind of like this. 39 trades, 1,100. If we look at our gross profit and loss, you can still see, and look what monster shows up on this trade. BPTH. I'm telling you, when you have runners like this, sometimes they skew your scans. And week by week you'll find, like whenever I re-backtest these, because I've backtest these probably weekly, you know, or so, you know, because market conditions change, you know, and what's working one week may not be working the next week, and what's working one month may not be working the next month. Just to give an idea of that ideology is look at the SPY. Okay, the SPY hits 2,800, and then we have a really big sell-off in December going all the way down. Well, you just switch strategies right there. You are uptrending hardcore, and then you're downtrending hardcore. Total change in strategy, and it changes the landscape of the market. So all of a sudden, if your 5-day momentum scanner has been doing you really good as the market's been strong, all of a sudden the market's weak, your 5-day momentum scanner just keeps hitting resistance and dropping, resistance, dropping, resistance, dropping, you know, over and over again. You'll find that during down markets that scanner may not produce the same winners as whenever the market's strong. So, you know, you got to consider what the market conditions are for the day or for the week or for the month, depending on how your scanner is going to react to it and what signals are going to be put out and how you should actually be trading the market. how you should be trading in the market. You know, like for instance, Friday futures were down, and since futures were down, the rest of the market was just having a hard time getting any push through. So all throughout the week, there was 100, 200, 300% runners. I think 100 and 200% runners, really. I think we had one that kind of went a little over 200 or something like that. But you had several of them all throughout the week as the market was going up. But then Friday, the market went back down, and nothing produced that day. You had, I think the biggest winner was 30% on the day. And that is not a running day. That is a day that you should sit back on your hands, or if you were a short, it would have been a good day for you. You could have really made really good bank on that day, as almost everything was going down. You know, so you pretty much had a feast in front of you if you were a short. And same thing as the beginning of the week. We had a feast in front of us as longs throughout the beginning of the week, because the market was moving up and most other equities were moving up along with it. So I always try to tell people to really pay attention to your overall market before you really jump into the day. You know, if your overall market is down and you're a long, then you really don't want to be in that day. But if the overall market's down and you're a short, then you want to be in the market that day. And the opposite is true. You know, if you're a long and it's going up, then you're gonna have that's your day to be in. And if the market is and if you're short and the market's going up, then that's your days to sit on your hands and wait. You know, wait for your moment in time. Now, I'm gonna go through just because I gotta show this to my boss kind of in a way, and kind of give him an idea of how these are actually producing. So this is kind of like a 2-in-1. As you can see, I have the VWAP scanner over here. And before I move on from the other, I have the VWAP scanner over here, and I was using VWAP up, and I'll just go through the settings because these are pretty standard. You have crossed above VWAP, positive VWAP divergence, flow to 50 million, max $25, min change 4% from the close, relative volume 2% ratio, and then min volume today was at least 200,000 shares. Okay, so that's the setting for this particular strategy over here. And I'm going to go ahead and run a back test on it real fast. 8 to 3 times exit 3 time of the scan will be for 62 days, and then we're going to simulate. So far, as you can tell, this is not going to be a big winner. Now, you can go about these scans two different ways. You could either look for high profitability scans, or you can, which puts you in kind of a high risk mode, but if you're up for high risk, then that's kind of how you do it. Or you look for long-term profitability, and there's two ways you would go about that. The high profitability, high risk profitability means that you'd be putting more down per trade in your account, and you would only put down for 1 or 2 trades, you know, per day or per week or something like that. So the goal is that you would literally be putting your whole account on the line, which is always scary because you should only put a percentage per stock. But that could also go bad too, and I'll explain that. Into a trade, and then you basically make sure that that trade is going to be highly profitable based off of, you know, how the scan is putting off signals, how consistently it's putting off the signals. So if you know that that scan keeps putting off those same signals every time, then you know if you can go in heavy or if you can go in light. If you have a scanner that puts you off a mix, then you don't want to go in heavy, because if it's 50 to 60% winners, then you're most likely going to get a really bad loser in there that will wipe out any gains that you had. Alright, so look at this one already. So we have 5,000, we put in 800, we're at 80,000 buying requirements, total loss 5,000 signals. Okay, so I altered this one, and let's run the same back test on it. And as I say, we're doing the VWAP up. I know I have more strategies in there, but we're only focusing on this one. 8 to 3, time to exit 3, so it's all the same. Time run 62 days. So this is the same scan criteria there. These are different. As you can see up here, we have min price $5, short growth negative, or short growth is 200%. Volume today is 5 million. Max price 200, and then the short max growth is 1100. So you've got a minimum here of 200 and a maximum here of 1100. Yeah, I know it takes a second. That's why this video is going to be a little longer, and I really hope a lot of people watch this video, because if you're a trade ideas person at all, this is extremely valuable. Extremely valuable, because you really need to know how to work your back test, because your scans will not really be worth it without having a good solid back test. And then you need to do forward testing too, so you should actually take these signals and do the same thing on your paper account, not your real money, your paper account, and you forward test these on your paper account, and you confirm that they're going to continue to put off the same signals as it was before, and you run it exactly like the strategy tells you. Exactly. Because that's how it's profitable. You know, if you change it, then it's like changing one of these here. Just a little change can make a big difference. Just like this, for instance, if I'm putting $800 in and I decide to put in, you know, say 5,000, you know, all of a sudden, let it load, give it a second, it's trying to load two things at once, then those numbers are going to change. So yes, I'll win more because I'm putting in more capital, but I'll lose more because I'm putting in more capital. And look at it this way. This is how bad this could have been. Yeah, I could have had a really big winning day of $9,000, but I had a really big losing day of $11,000. That's $3,000 above that. So say I had on 3-1, I had a really great day. I walked out of there happy. I made $9,000. Woohoo! Right? But then, what? 8 days later, you know, not 7 days later, a week later, I'm losing $11,000. Where's the woohoo in that? I'm upside down, you know. And then, as you can see, I would be continuously upside down with the strategy. It's down, 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 with a little bit of up and a down, down, down. So if you're actually looking at like the stock market, and you're looking at a stock and it's going down, you're in the same shape with your strategy. Your strategy is mirroring a down market. Now, say if I was to, you know, this would be a great short strategy. If I was a short, like, watch this. Let's run this again. Instead of a buy, simulate buy, let's simulate sell. Just to see the difference. I mean, it should be all these numbers reversed. 41% winners, 47.98 that, but the profit factor should be totally upside down. Give it a minute. But yeah, you really got to stick to what criteria you put in, so you really, this is you building a plan, is the way I look at it. You're building a plan. You're not just building a scan, you're building a plan. It just depends on how you look at it. uh, I can look at signals all day long, but those won't do me no good. That's the reason why, like if I'm in the room and I see people call out plays all the time. I don't play those plays. Why don't I play those plays? I don't play those plays because the person who called it has already seen it, and by the time I'm seeing it, I may be too late. They should have been in it as they were calling it. And if I'm following that, then I'm chasing their call. I'm chasing the stock, and you don't want to chase. So you may be late to the party, and the same way comes with these. Now, what did I do there? Okay, so look at that. Big difference. Same. The win rate's actually higher because it's a winner versus a loser. Your return is way different. 337%. Your biggest winning day is 11,000. Your biggest losing day is 9,000. It's still a losing strategy, guys. Okay, whether you look at it or not. Even as a short, it's still a losing strategy. And the reason why I say that is because your win days and lose days still match up at 50%. So even with this one giving you bad negative territory, this one still has very big potential to do the same thing, okay? To give you the same bad potential, so it just depends on how you look at it. But I would rather be short on this strategy than long on this strategy, because short on the strategy over the course has a higher probability of being a winner than the long does. So how did I change that up? Now for me, let me go back to this other one over here. I had to make some alterations to make this strategy here, and even this one right here, because they're the same, just flipped. One's a buy, one's a sell. This is the sell, this is the buy. But I want to be long, I want this strategy here to be good. So how do I do that? I had to take out a whole lot of trades, and I did. And look at the difference. 68% winners. Your profit factor is higher. Buying requirement is way lower, 500 to 15,000. Still putting in $5,000 per trade. Biggest winner is $5,000. Biggest loser is $1,000. That's a better strategy for a long. I could play this strategy where I couldn't play this strategy. Big difference. So this is my view of looking at scans and how to do risk management. Your risk management is how much you're putting into the trade, how much you have to work with, how many trades you're spreading it across, and how long you're holding it for. Whenever I first started trading, I wasn't trading my own money. I gave my money to a financial advisor, and they created a diversified portfolio. And that portfolio was producing around 4 to 6% per year annual return. Now, that's not bad, okay? When you got $200,000 and it's making that much, you're roughly making about $20,000 a year. So that's about what a fast food person would make. That to me is not good, or not bad. That to me, for doing nothing, not working at all, is pretty good, So I didn't mind that. So with that though, if you've got a smaller account working with smaller money, that's not going to work for you. You're not going to make $20,000 a year. You're going to make maybe $200 a year, so that would be good to pay off a utility bill or something like that, but that's not going to compound your interest. So you have to trade differently. But to do that, you take the same concept, but you put it into a smaller fashion. So how do you do that? You do that with a plan. You do that with risk management, and you do that with higher probability wins, so that account can grow faster, you know, by basing out how many trades and how to spread them, you know. So now that I've kind of gone over that idea, I want to just go over the back test now of the scans that I have in place and kind of show the history of the signals a little bit. Okay, so I'm going to start off with this one over here, my multi-strategy bull. And it puts off a lot of really nice signals. And a lot of these are winners. Almost every single one of these, I believe, are winners. And I'm not saying every one of them are winners, because there's going to be losers in here. And as you can see, a lot of these were popular runners throughout the week. AKTX, AMD is always popular, Gold, TVIX, KGC, GE, VESTM. A lot of these were pretty decent plays. Seal, that was a good runner. Alt started to run for a few days. VPTH obviously was the biggest runner that we've had this year, period. Let's see, HUY was one, ACB was one, JMU was one, CIFS was a pretty good runner actually, and actually held most of its gains, and I still have some money in that one, where I'm actually still holding about $1,000 profit. It still hasn't really let off, so that was a pretty good play if you ask me altogether. But let's see what it brought up. Okay, so back here, VIPS, it put off a signal for this day, and if we zoom in a little bit, you can see that the following days was up from this particular day. So you could actually have bought here and held for 3 or 4 days and gained extra profit off of it, not just had to sell out that day. Voxel, it was that single day, but it held in this range. So even if you did buy this day, as long as you didn't buy over closer towards this resistance, you were still good, and you may still be good because, as you can see further down the road, it's still spiked up. Voxel's usually not one that I like to play. I've played it before in the past and have been burned by Voxel. So it's one of those that it hits resistance pretty fast and then falls. FDC, as you can see, it went up for 3 days or 4 days after that, and then it consolidated into a range. This would be considered a longer term bull flag, and I would expect this to probably finally break out of this $25 range coming up in the near future. PCG, buy here, and as you can see, 4 or 5 days later, maybe even 10 days later, you could have been up really good, because you were coming off of what, $7, and then just that day alone it went from 7 to 14, so it doubled. Just that day alone it doubled. Or actually maybe even the day after it doubled, because I think the signal might be for this doji. Yeah, the signal's actually for the doji. For the next day it actually doubled, so it kind of gave you a precursor of what the next day would be. And a lot of times, okay, I'm going to tell you this before I go any further. A lot of times people will be like, boom, I seen the signal, I bought. And that's not maybe a bad idea, but how about this idea? I seen the signal, I wrote it down on a piece of paper, I wrote the date, I wrote the price, okay? And maybe even wrote up what other data if I wanted to add that, what was the volume for the day or something like that. I probably would write what the volume was for the day, because I like to go off of volume, and if volume is over 1 million shares traded in a day, that's typically where your money is. Because think about this, for you to trade, there has to be people, there has to be activity. If you're trading a stock that has 300,000 shares traded in a day, it actually may not have enough liquidity for you to get decent size. Okay, so over 1 million shares, if I wanted to put in my whole account, I could easily put in my whole account with 1 million shares with some slippage, but not as much slippage. But if I had 300,000 shares and traded in a day and I tried to put down my whole account, then I'm going to have serious slippage, maybe not even get fully filled. And whenever I do get filled, I want to get filled for way higher than I want to be in. And then I find myself upside down instantly in the trade versus right side up instantly in the trade. And that's because liquidity issues, you know. Okay, so let's keep going further. Nokia gave me about 3 days as long as I didn't buy there above it. GDX, 4 or 5 days. You can see that most of these give about 1 to 3 days range. Not all of them, but most of them. But what I look for is patterns, average patterns. Now see, this would have been a bad loser, CODX. But just to give you an example on that, that's the reason why I say write it down the first day. Write it down the first day and see if it has follow through. If it has follow through, then you really want the second day and third day and fourth day, because then you can put in more money into those, knowing that it's got a little bit higher odds. You know, see this scan, because this scan right here obviously produces a pattern. You know, it produces this 3-day up pattern or 4-day up pattern over and over again. AMD still did this swing up pattern. It was actually still moving up at that time. GE, 3 days. APHA, 4 days. Okay, that is a good scan to me. Let's look at this one. I love the bullish candlestick pattern, and whenever I did this one last night, and I loved it because it was consistent with a pattern. Simple, easy pattern. Okay, so KBR, let me zoom out a little bit. This is a bounce scanner, and it really finds the bounces in the market. The market was going down, it hit bottom, and then subsequent days went up. Next signal, down, bounced, went up. Next signal, I'm going one by one on this because this one really I loved. Down, bounce, up. Next one, down, bounce, up. Next one, down, bounce, up. That's what I want to see in a scan. I want to see a pattern that it finds every single time. VZ, down, bounce up. Look at this though. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days. I could have held that if I wanted to. Safely, confidently held it. Next one. I'm just continuously going. This is just one after another. Push down. And this was a little slower. This would have been a consolidation here. I would have held this one a little longer than I probably would have wanted to, and I probably would have been more nervous about this one because of its gappiness, but it would have eventually gave me what I wanted. It just wouldn't have given it to me instant. And I do got to go through that with people too. We're trading, we're not in fast food. We don't get it instantly. Okay, sometimes your trades aren't instant. Instant gratification can be bad to your trading, okay, because you have an expectation that you're going to be at a certain point, and then whenever it goes out of that point, you sell in a panic, and then you're down money. But then if you would have been patient just a little bit longer, you probably could have either been broke even or in the money, you know. But the same is true there too. So I mean, there is risk management to that, because say you had done that here in this section, thinking that same thought pattern that it was going to do this, and possibly come up out of it, it could have shot down, and then you could have pretty much lost a lot of money here, you know, going from, you know, what was it, $40 a share down to $30 a share. But as you can see, it still went almost back to where, you know, you bought in at, you know. So you could have still come and, you know, even say if you held and you lost a ton of money here, you know, you still could have waited and still broke back. And I say that because a lot of times it happens like that in the stock market. You'll hear people, and don't get me wrong, pump and dumps will literally pump and dump you. So like BPTH, whenever it was coming off of $3 to $5 range, that was okay. But the second it hit over $10 and shot up to $73, whoever bought anywheres above that, was taking a very high risk. So people sitting in the $70 range may either have the choice of either losing all that money or having to wait a year, 2 years, or whatever to possibly get half or all of it back. So not saying that they probably won't get it back. It's just that your long-term hold is going to be a lot longer. But just remember this. All sales aren't final until you finalize the sell. Okay, so if you buy something and it goes against you, and you could go into margin call or whatever, it's still not over until you sell it, you know? So it still has potential to come back, you know? Just an idea, okay? And I say this because I made a lot of money with long-term holds, you know? And long-term holds can pay out if you plan them, you know? The way I do long-term holds is, especially if I like to do a long-term hold, is on a dividend stock. And I do that because a dividend stock allows you to, you know, rent the stock. So say if I bought in the middle range here with a dividend stock, then I'm making profit as time goes on because I'm getting paid dividends. I'm renting the stock. And if I buy in the middle, if I'm up here, I'm in profit. If I'm down here, I'm in loss. But I'm always in profit because I'm constantly renting the stock. So 2 years later, I'm still renting the stock. You know, I'm still gaining money off of the, basically the dividend. So with that said, if I am in loss territory, then I may break even based off of how much I made off of dividends. But if I'm in profit, then it's kind of like renting a house and having equity. You basically are paying down your equity and you're gaining rent at the same time. So you're making money on both fronts. You know, if I decided to sell up here, then I would have made not only my stock profit from just it being in the market and going up in price, but I would have made money over time as time went on with the dividends. So say if I've got 5,000 shares and they're at $1 dividend every quarter, I'm going to make $5,000, you know? So I mean, that's just the, you know, way I'm going to look at that. Every quarter I'm going to make that amount of money because I'm going to get paid that dividend. And then on top of that, if I decide to sell the stock for a profit of, say, $1,000, well, then I'll be up $6,000, you know, total. You know, so I mean, that's just another way of looking at the market. You know, not everything has to be point here, buy, sell. There's other ways of going about it. All right, so I'm going to finish out this video just kind of showing you the results of the back test of each one of these and what their numbers are. And then I'm going to close everything out. So I have this one set up to buy at 9 o'clock and sell and stop buying at 1 o'clock. So between 9 and 1 is your prime times to buy. Your exit is at 30 days out. So this is a 30-day hold. This is a penny stock, one where you only invest $100 to $200. This is about to give me a crazy number real fast though, so don't pay attention to that much because, like I said, you're only supposed to invest 100 to 200. I'm going to put 200. And technically I'm below what my buying requirements are, but biggest win day 3,000, biggest lose day 200, 68% winner, 159% strategy return. And even with this buying requirement problems, then these numbers would only be skewed to the point that I would actually probably be making my biggest winning day would probably be about $500, and my biggest losing day would probably be like $20 technically. And that's only just based off of what the buying requirements are and me doing some simple little math in my head. So this one's almost a 70% winner, only 132 trades. So that gives you a little bit more ability. If I wanted to just play one trade and put my whole account, say I was a jackass, then my biggest winning day is $84,000. My biggest losing day is $5,000. So potentially I could have made all my money back in one trade, or I could have lost all my money in one trade. Just that simple. Not much more past that. That's the reason why I said do the $100 to $200 range. Like say if I did $100 range, it's closer to my buying requirements. Well, say if I did 50. Let's just say I did $50. All right, at $50, just putting $50 per trade, guys. Let me rephrase that: $50 per trade. Okay, small account, $50 per trade. Biggest, and look, the buying requirements are really, really close. Okay, if you want me to build you something like this based off of your profile of what you have in your account, I can, so just hit me up in the room sometime if you want me to do that for you. The biggest win day would have been $830. Biggest lose day would have been $50. I would have lost just my initial investment that day. So just take that in consideration. By the time that would have been over, I could have been up $7,000 on a Robinhood account, and up $1,000 on a little over $1,000 on my TD Ameritrade with $5 commission. Which with them you can actually have that change. So they start off at $6.95. I got mine down to $5. I'm about to go with them again because I know somebody who just got theirs down to $2, so I'm going to try to get mine down to $2. And I screenshotted it, so I know that they can't argue with me. Okay, so this is my long-term 30-day hold, putting in $50 per trade. And what happens is with this one is you buy every time you see a signal. That now if you see multiple of the same stock, you only buy the trade once. Okay, not every single time you see it. Okay, but you buy it. You buy the stock once, $50, and then you hold it for 30 days, and 30 days out you sell that stock. But as you're going along, you're still buying more. Okay, so that's how this goes. This is a rolling strategy. So as you buy one, you mark it on a calendar, and then 30 days later you sell that one. But as you're going along, you buy the rest of them as they're going along. You hold those, and as 30 days goes out, you sell those. And as new ones come in, you buy those, and 30 days out, you sell them. Over and over and over. Rinse and repeat. Okay, that's how that works. Rinse and repeat. Buy for 30 days, sell at 30 days. Once your buying power is, say for instance, say you bought enough trades to fill up your whole $5,000. Well, then you're obviously not going to be buying no more, so you're holding. And then as 30 days goes on, you drop off the one, you drop off another, you drop off another, and you buy another, and you buy another, and you buy another. And you keep this strategy rolling. Okay, so that's how you play this. Okay, you don't just buy one day and then sell the next day, and vice versa. You have to play it by the strategy. So it's a rolling strategy. This one is my multi-strategy bull. The buy time is at 9:30. The sell or buy zones are between 9:30 and 11. exit time is at the end of the day. This one requires you to have a little bit more money, I believe, per trade for it to be profitable. And the reason being is because the price of the stocks are higher. You got to think, okay, if you were, okay, so let's put this in a poverty perspective, okay, rich versus poor, okay. If I have $1,000, or say I have $1,000 in my account, versus say I have $10,000 in my account, the $1,000 person is going to be eating at McDonald's, guaranteed, and maybe not even be eating there. They may be eating at Walmart with beans and rice and sausage, okay. The person with $10,000 in their account might can afford not only McDonald's, but they might can afford Outback, or they might can afford Red Lobster, you know. So the same goes with stock prices. The smaller your account, the smaller the price ranges you should be searching in, because you can only afford to put in so much per trade, you know. And if you're buying $1,000 stock with $1,000, you're buying one share, you know. That does you no good. If you're buying, say, a $30 stock with 1,000 shares, you're spending, you're getting only 30 shares, you know. So for that to be profitable, it has to move quite a bit before you're actually going to be in profit. So with the smaller account, saying you're staying in the $1 to $5 range, then whenever it makes a move, that move actually allows you to capture more profit based off of how many shares you're actually able to purchase versus, you know, what your account size is, which is another part of risk management in a different fashion. So basically you're looking at it this way, that you can only afford certain types of stocks. It's kind of like if you smoke cigarettes, you may only be able to afford Pall Malls if you're, you know, hardly have any money, and then if you have some money, you might be able to afford some Marlboros. You know, difference is $1 per $1.50 per pack versus $8 per pack. You know, same thing goes with food. You know, I'm just, you know, just examples. There's so many examples that I could use like that. You know, but you should view that the same way. Okay, so now with this strategy, like I said, this one's going to require more capital for it to be profitable. So this one actually requires you to have $1,000 invested in it. But you get 38 trades, and I use this one differently than the other because it's not so much a rolling strategy as it is choosing the better play to put more money down into. So basically for the day, you're not going to get a lot of signals. You're going to get two, you know, you're not going to get like 20 signals per day. So that means that you can put down more of your account into that play, and you'll make decent profit off of it.
Dad, the baby's awake.
Okay, thank you. I'll be in there in a second. Alright guys, with that I'm about to have to shut down because my 3-year-old just woke up and she is not always the happiest. So what I'm going to do is I'm going to run a back test on all of these real fast. Simple back tests. Just to show the profitability. These are the only few that I'm actually using. These right here, and this one right here, and this one right here don't count. Why are you going out the front door?
I just unlocked it.
Is she in a crying?
Yep.
Okay.
I hear her. And when I was watching Mickey Mouse and I heard
Well guys, I actually don't have time to finish these out. I will go actually through the backtest strategies fully different, but alright, so that was my examples of this. I hope this helps y'all with, you know, how I view scans and how I view the market, and this is just a small part. I really could go into detail for probably about another 2-3 hours easily, and I'm already an hour and 25 minutes on this recording alone. So I will bring that back up later on, and we'll go through it deeper later. And I hope y'all enjoy, and I hope this helps you out with your trading and kind of gives you a view that the market isn't as you would assume. You know, you don't just throw things at the wall and hope it sticks. You find something that's worth sticking with, and you stick with that. Um,